Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So what will be our today's topic, Nick?
All right, so with this video, we're going to discuss more of these terms that need clearer definitions. Last video, we talked about speculating and gambling, and today we'll talk more about arbitrage and real investing, at least what we consider real investing. Arbitrage, the practice of taking advantage of a price difference between two markets. So, for example, if you buy vintage clothing on eBay and then sell it for double or 4 times more on Etsy, you know your markets. You know that you can get it cheaper at one market, and then you can arbitrage that to a market where the average price for that item is more. There's lots of cases of that in reality. In fact, in the early days, you could go to one market and buy a huge quantity of some kind of commodity, like wool or potatoes, and then you would simply drive it to the next state over, and you go to that market where you knew the price was higher, and you'd make the difference. So arbitrage is any time that you're taking advantage of price differences between two different markets, and that can be used in the stock market, but typically those margins are very small these days. We are much more efficient, so there's less of a difference between two different markets, and yet it's a very good concept to know. In business, arbitrage is often the main place that you make business profits. Your supplier provides it to you at a lower cost, and you sell it for more to your customers. What are your thoughts on arbitrage?
Yeah, I think that this is a really powerful style, I would say, because even Warren Buffett started these workouts and arbitrage deals in the early 1960s. And this model can really make you a huge sum of money in the short-term perspective. But you need to really understand the market on which you are buying and selling. And you really need to understand the risks and potential returns for that. The example in the stock market can be buying the particular stock, like Warren Buffett did with the Activision Blizzard. And there were rumors that Microsoft would buy this company. Shareholders will receive the Microsoft stock or the compensation for their purchases in Activision Blizzard. So as a result, this is the purely arbitrage deal. If everything goes according to the plan, the investors will receive the pretty high revenues for their investments.
I think that understanding arbitrage can definitely help you as a business person, as an entrepreneur, as a startup, and as an investor. Personally, it is a large and interesting category, and effective and efficient, but you do need to know what you're doing and get really good at understanding all the facets of that particular type of business. So now we move on to investing, and I believe that all real investing is value investing. That's when you know the underlying asset's value separate to its price. And if you can't do that, you're not investing. You're probably speculating or gambling or doing some form of arbitrage, but it's not the same thing as investing. Investing is when there is very low risk of downside with a very good risk of upside, a good chance of upside. And we do that, and that is what we talk about here on this channel. What are your thoughts on investing?
In comparison to other styles which we described previously and in previous episodes, investing is method when you consider the business and the stock as the part of the business. And you consider that you buy the securities for the long term, adding money and adding value to the business. And eventually, this business will produce more goods or services and increase their value for the particular community or country. And as a result, you as a shareholder will receive more increasing in the stock price, and the company will receive more revenues and incomes. So this is quite different mindset and ideas from the trading or speculation or arbitrage deals, when you just focus on the short-term gains and particular situations.
Frequent trading is hazardous to your wealth. There is only one length of time for real investing, and that is long-term investing, because that's the only term that really counts. If you're trying to build wealth, you want to be certain about it, and certain and time is definitely connected. So if someone's trying to sell you something that returns 20% a week or something like that, do the math using a compound interest calculator, and you'll fast see that it's impossible. Because if it was true that they could give you 20% a week, then in just 3 or 4 years they'd be richer than Elon Musk. Compound interest is an amazing thing, and figuring out how realistic, how likely is it to be true when someone presents you with an opportunity. Use your judgment. If it sounds too good to be true, then it's probably not true. The best investors in the world, are typically making over a 10 or 20 year period an average of 15 to 30% per year. And so if someone's offering you something that seems a little outside of that, you should be very skeptical.
Yeah, and my thoughts about that is try to consider this situation. For example, you are the owner of the retail company, and you open offline retail stores and locations in different countries. How you could possibly increase the revenue on 1,000% per year, just opening 100 stores in the same day? If you are not trained, and if you do not have enough capital and enough resources for that, it's almost impossible. So you cannot produce such high returns on the investing and high returns on investors' money. So, as Nick said, everyone who offers you the high percentages per week or per month, you need to be very careful with that.
As an investor, you need to know that you're getting into the right real investment each time. And so that's why we give you these broad definitions to think about. So when you think you're investing, think about, does it have an underlying value? Am I buying it at a discount? Or am I doing something that's closer to speculating? So being aware of which one really helps. But there's other things that you as the investor should consider. And so I'd like to move into that as our next point. One of the aspects of being an investor is just being good with your own money, making wise decisions, investing in your own business or in your own life. And probably one of the most helpful concepts I've found is the idea that there's two kinds of debt that you can get into. There's good debt and there's bad debt. And the definition of that, as I see it, is a good debt is something that will bring you a return, a definitive, actual return that is higher than the amount of the debt and the interest over the course of that debt. And so if you're doing an investment into something that you know will return, for example, you're starting a business and you know that the business is going to bring in, $3,000 a month or 10 grand a month or whatever it is, and you need to buy certain equipment, and you don't have the money for that equipment, and so you borrow it. You get a personal loan, you get a business loan, or you put it on your credit card, or you borrow from family with or without interest. That is good debt because it's going to generate more than what you're losing on it. If you want to buy yourself a fancy car or a fancy watch or some fancy clothing, most of the time, those things are not going to bring you more money as a return. And so that would be considered bad debt. And so always pay attention to whether you're bringing up good debt or bad debt. And think carefully about using bad debt, because every cent that you spend on bad debt, it's probably going to be like spending 40 times or something that amount, not just because of the interest, which is usually exorbitantly high. And if you just pay the minimum, it'll take you 7 years to pay off, and they've doubled that money twice in that time. So that's the one way of looking at it and going, wow, I thought I was paying $20 for this t-shirt, but I'm actually paying 80 over a 7-year period or something like that. So you need to be very considerate of how that actually works out, how much you're actually paying for the item after paying off for so long. And then the other is the opportunity loss. If you put that $20 into investing into a stock that doubles your money in 3 years, you offset the one to the other, you'll find that it's staggeringly a lot that you're paying for that $20 t-shirt if you're losing out on the gains. So these are some things to consider: good debt and bad debt. What are your thoughts on that, Eugene?
I definitely think that this is one of the most important points for building your wealth. And you need to be very careful with good or bad debts. Even if you still want this car or new laptop or other thing which is considered like the bad expense or needs bad debt, I try to use this clever mental trick, and I try to think and figure out how can I transfer this bad debt into good one. So, for example, if I'm purchasing the laptop or the car, can I use this as the business expense in order to earn more money? So, for example, building software or delivering some products to other people or helping others receiving the money. So, and in this case, this expense can be the good one, and you can calculate actually the return of your investment, and it can be considered as the investment into your small business or the small side hustle of yours. I think that this can really help. It can improve your life for the better.
Absolutely agree. If you're going for job interviews and you're wearing nicer clothes, that could get you the job, and that's a great return on investment. You need to know what you're doing with that money. If you're doing something that's not going to bring a return, consider strongly not doing it. Obviously, some things have a non-monetary return that is worth it. Going on a vacation can de-stress you and make you happier in your life, live longer, healthier, more productive. And so that's a non-monetary return. But you do need to be very careful about ringing up debt. I like to use actual money, not debt, for those kinds of expenses where possible, because debt is a very heavy burden, especially if you're paying high interest rates. I'll give a little tip about that, though. If you're suffering right now under a huge amount of debt, and I'm not talking student debt, I'm talking credit card debt, 21%, 25% credit card debt. If you're suffering right now and you're hearing this, let me tell you, a little secret could change your life. I'm hoping I'm going to save you thousands of dollars and a lot of stress. And this is my tip: contact your credit card company. Tell them that you are suffering with this. You are struggling. It is a tough time in your life. You are really, maybe over leveraged. Your pay has gone down. Something, has affected your life, and you're really struggling. You want to pay your bills. You want to be a good person, but you're asking them, is there anything they can do? And guess what? Most of these companies, while you think they don't care, they actually do. They will transfer you to a department that will give you a far lower interest rate, which will really help you either to pay off the debt quicker or to lower the monthly payments so that you can continue to eat and pay your rent. And I've negotiated for myself and for others because sometimes I take the role of helping others with their issues. I've negotiated down from 25% down to 6% or 7.5% on many credit cards. This will help you a lot. And all you have to do is make that phone call, admit that you're struggling a little and you need a little help, and they will help you. The only downside is when they do this, they convert your credit card into a personal loan kind of situation, so you can no longer use that credit card. But often the return of getting that interest rate down is well worth no longer being able to use that card. does not affect your credit score. Just make those payments on time, and you will have extra cash to either pay off the loan quicker or to do other things like invest or pay your bills. So that's a little life tip. What do you make of that one?
Yeah, this is a really great tip how to restructure your debt, and I hope it can help our audience in life. But anyway, we still moving on, and what will be our next point?
I'd like to discuss a related point. It's about thinking rationally about all of your choices with your money. So let's just say that you've got a mortgage and a car loan, and you've got a credit card, and you've got the opportunity to invest that money too. You've paid all your minimums on all your cards. You've got a little bit of excess capital. What do you do with it? So I would argue, and this is very different to a lot of the large famous guys who talk about money. They all say, pay off your debts, and that's the first thing you do before you invest. And I disagree. I think if you think rationally about it, you can know which is the best use of that money. So you obviously pay your bills as you're supposed to, but with that excess capital, I wouldn't pay down my house faster if the house is at a 3% and my car's at 5%. I'd pay off my car. And I wouldn't pay off my car if my credit card's at 6% and my car's at 5%. I'd pay off the credit card. Always pay the highest debt first. And if all your debts are low, like say all your credit cards, you've gotten them down to 6%, why pay those off if you know that you can get better returns on the stock market? If you know that you're going to get 10% or 15% or 26%, so long as it's higher than that 6%, you're wasting money if you pay off that card quicker. I would put that money where it's going to grow the fastest. Always compare the percents and go with the one that is the highest, either in growing your money or in what's taking away your money. Tackle the highest first. So if you know you can get a higher return than your highest debt, don't pay off the debt quicker. Get that higher return. That's what's going to help you more. And that's my thoughts on that. What do you think of that?
This is a great idea, but this is still not financial advice, and we hardly recommend you to go to your own financial advisor about that, because usually if you do not have a proper knowledge about the stock market and the investing in general, this can be a really big trouble for you, because this money, which supposed to be covering your debt, can go down in your positions. It usually happens. It can happen nowadays because due to turbulence time and all these economics downturns. So you need to be very careful with that. But anyway, restructuring your deals is always a good idea because you are receiving lower interest rates. And if you just compound all this stuff, and if you pay and invest wisely, without paying, as you said previously, most of your debts, this can probably give you more returns in the future for the long-term period than in the short term. But you need to be very careful with that as well. So this is the end of this episode, guys. We think you really enjoyed it. And if you have any questions, please write them down in the comments below. Also, please join our Discord group where we discuss different stock ideas, investing books, guru picks, and others. And see you next time.